Okay, good afternoon, everybody. Let's go ahead and get started. Let me know if you guys can hear my audio and see my screen in the chat box. Just give me a little Y or a yes there. Just let me know that you can indeed hear me. Just want to welcome everybody here. Also want to welcome anybody new with us today. If you are new, let us know in the chat box what state you're from or what country you're from. Also want to give a shout out to everybody watching this in the recording. If you're on YouTube, just want to welcome you here and want to say hello to you. If you have questions throughout the webinar, if you're here live, feel free to use the comment section or the chat box to ask those questions. If you're here on YouTube or in the recording, feel free to ask those questions in the comment section down below, and I will answer those as soon as I see them. But let's go ahead and get started, everybody. So today's topic is going to be on risk management and the importance of risk management. We're going to do a couple of things. We're going to go over why risk management, what it is. We're also going to talk about toxic risk management styles that are pretty common in the foreign exchange market and other markets, and how to avoid them. We're going to talk about, we're going to do an activity where we go over 4 different risk management scenarios and the break-even cost basis analysis, all that kind of stuff to help you guys understand what's required to be profitable in the markets and what strategies lead to the profitability that you're looking for. Okay, so let's go ahead and get started. As always, I need to remind you guys about the risks involved in this market. You can lose all or more than your initial investment if you're not careful. So please be aware of how many pips you're risking on each trade, in addition to how big your lot size is and ultimately how that would affect your account if you were to lose money. So make sure that you're going through that process each and every time that you take a trade. All right, guys, so let's first start off by talking about why risk management. So, sometimes there's a lot of different types of investments out there, right? I think when people kind of get started with investing, they just kind of open up an account and throw some trades at Tesla or Facebook or Apple or something like that. They just want to kind of throw trades out there and see how things play out. And they don't really have a stop loss or an exit strategy in place. And that's just, in reality, they don't really know it, but they're just gambling, right? As traders, we know that there's a much better way to trade, not only to protect capital, but to accelerate the gains that we already have and accelerate, put the capital that we do have on the fastest path to growth possible, right? But the first thing that we have to do before we can start making money in the market is protecting capital, right? I think Warren Buffett said the first rule of trading and investing is to not lose money, and the second rule of trading is to not forget rule number 1, right? And he is so right. So we have to, I'm just going to read this here. We have to manage our risk by having preservation of capital. Forex trading involves the potential for significant gains, but also substantial losses. By managing risk, you aim to protect your capital from substantial depletion or capital loss. Preserving trading capital allows you to continue participating in the market and seek profitable opportunities. I like that last part, because if you don't manage your capital in such a way that would preserve it, what ends up happening is you lose all the money that you planned to bring to the market. So a lot of new traders, they don't have tens of thousands of dollars or hundreds of thousands of dollars to really start making a full-time income with. They'll come with a couple $1,000 and they'll blow that $1,000 in a week, and then they'll say trading doesn't work and anybody who does trade is going to lose all their money. When in reality, there's plenty of people who make money full-time in the markets, and they do it all the time. And it's because they don't blow their accounts. They don't lose all their money that they put into the market to begin with. And we're going to talk about those strategies and how we manage that, how we ensure that that doesn't happen. One thing that I often say, and I do want to be careful with the way I say this, because this is personal to me. I'm not saying it's for everybody else. Okay. But for me, trading is the least risky thing I've ever done, but the highest, with the highest reward tied to it. I have 401ks, I have IRAs just like everybody else, and I do contribute to them. But if you think about it, there is no stop loss on your IRA. There is no risk management parameter in place for your 401k. If something crazy happened in the geopolitical world that we live in, that capital is at risk, right? I don't think people realize it, and I'm not trying to be like a doomsdayer here. I'm just spewing facts, right? But in 1929, when the stock market collapsed through the Great Depression, that market fell 85% before it was done. It took 2 years. By 1931, the stock market fell 85%. So if you had $100,000 in capital in the stock market in 1929, by 1931, it was worth $15,000. And I don't think people recognize that or understand that that is a possibility, right? Now, I'm not trying to say that hasn't happened since then, by the way. We've never had such a collapse since then in the markets, but those types of losses are on the table. Now, in trading, I don't take those types of losses, even if that kind of loss comes along for the general market, because I'm using a stop loss, because I'm using a lot size calculator, because I'm using a trailing stop on a lot of my strategies, right? When I do those kinds of things, I am kind of giving myself a shield against the general market. So I will only make money if the market goes the way I want it to go, and will let that thing excel and go that way. But if the market wants to cause my trades to lose, fine. Okay, I don't like it, but you can go take my trades and hit my stops, but it's only going to lose a certain amount of money, right? So anyway, that's my philosophy. And that's why for me, I put way more money into trading than I do into my 401ks and IRAs, because I actually have those things in place. And I don't have those things in place, unfortunately. And I would say 99% of people, perhaps 100% of people, don't have those things in place on their retirement accounts. And it's unfortunate, right? So you're kind of subject to whatever the market, the government, the economy, whatever they want to do is what happens to your retirement. My answer to that is no, thank you. I'm going to take control over this because I've got the know-how to do this, right? So anyway, let's talk about this. Let's continue our discussion here. So why we manage risk, long-term sustainability. So a lot of the times traders, they get into the market, they'll just start taking trades, putting stop losses wherever, or maybe not even using one at all. And that's not a sustainable way for the future. Everything has to have an approach that would cause you to continue to trade next month, next week, and next year. Okay. Another thing too is emotional control. I sleep better at night knowing that I'm managing my risk, right? I wouldn't be able to sleep at night knowing, or I wouldn't be able to go into the weekends if I have trades open knowing that, hey, if this thing just goes wrong, I could lose a lot of money, right? So I have to make sure that I have that in place so that I can sleep and so that I can enjoy my life outside of the computer screens and the markets, right? Okay, let's go back. Unexpected events. We talked a little bit about this, right? We live in a crazy world. There's always news, right? How do you know there's always going to be news? Well, because they have to sell ads, right? So there's going to be news tomorrow. There's going to be news on Friday. There's going to be news in a year from now. There's going to be news 10 years from now. And that's always because they have to sell ads, right? So, and the thing is that those news sometimes are not, they are a big deal, right? So when there's new wars that start, when there's things that happen to economies and governments and elections, right? Those kinds of things really affect the markets, right? So we have to have these stop losses and things in place and manage risk just in case that kind of stuff comes along. Does that mean we don't trade because that stuff's a possibility? No, I embrace it. I embrace these things to make money. So don't look at this kind of stuff thinking, oh, because of bad things in the world, okay, that means I don't trade. No, because of that, that's a huge opportunity. That's how we have to look at it. We just have to go about that opportunity while managing risk, right? And then the last thing is risk of ruin, right? Because, and we already talked about this quite a bit, and I'm going to talk about the styles of trading that will lead you to ruin. And I've done this on different accounts, and I'll probably share some experiences with that. But risk of ruin is where basically you put in a couple $1,000s into your trade account, and ruin would be basically you lose all couple $1,000s, maybe even more if you were margined on a position. Okay, so we never want to get ourselves into that type of a trade. And I will teach you how to never even get close to that, not even close. Okay. But these are what are at stake if if you're not managing risk. So yeah, if you want to do this long term, if your goal is to trade 20 years from now, if your goal is to get millions of dollars in funding, and your goal is to be a long-term trader, then there's no other way. You have to manage risk. All right. So let's talk about toxic trading styles. So Martingale is one of the most toxic trading styles. I'm not going to read all of this because it's a lot of stuff. So I'm just going to kind of explain what Martingale is. And I want you guys to pretty much stay away from this. Now, I do want to say that not all Martingale is bad if it's controlled, and that's the key word, controlled. Now, I'll be honest, I really don't like Martingale styles at all. In fact, the only Martingale styles that I subscribe to I've got a couple of robots that are very controlled, that do participate in a level of Martingale. There's like a taste of it, but it's extremely controlled. But it is extremely toxic if you go 100% Martingale. And in most cases, Martingale will lead to your ruin. It'll totally destroy trading accounts. Martingale is responsible through trading for a lot of divorces, because if you have think about it, if you put in your life savings into a Martingale system that goes bad, you could lose your life savings just like that. You could lose your home. It's really bad stuff. So let's talk about what Martingale is. So Martingale is a betting style, where you double down a position. Let's say you take a trade, you lose that trade, and you double the next position in hopes that the next position is more profitable. It's very common on a roulette table. If you think about it, somebody who goes out, bets black, let's say, and it doesn't work out, the next trade or the next time the roulette table goes around, you just bet white, and now you double down white. And if white wins, then you recover all the losses from black and you make it up through your win on white. Now, if white loses, then you double down on black, right? And now you're 4 times bigger than your initial bet, if you think about it. And if that doesn't work, you switch over to black again, and then you double that. Now you're 8 times bigger than your initial bet, plus all the losses you've had in between, right? So you can see how that can get yourself into some big trouble if you don't hit a winner. So if you're likely to hit a winner pretty quick, then it's usually not a problem. But the problem is that if you do this 100 times on a roulette table, there's going to be a period of time where you're going to be wrong, 6, 7 times. I think it's kind of statistically proven by the 6th or 7th double, usually your trading account isn't big enough to make that double. And then there's this other scientific feature where if you're doing Martingale, by the time you get to like a 7th or 8th double, maybe even the 6th double, it would no longer make sense to even use Martingale, because the gains would be so small, because you'd have to start with such a small position in the first place to be able to double up to 6, 7 times. Right? Because if you start your position if your initial starting position is kind of bigger to begin with, and then you double and double and double, well, you have fewer doubles to work with, because by the time you get to your 7th double, you can't, because your account's not big enough to create that doubling. Plus, you've already taken all these losses anyway. Now you're trying to make a double, like you can't do it. So basically, basic systems that require 6, 7, 8 doubles, I think it's around there. We'll just say it's 7. By the time you get to your 7th double, it doesn't even make sense to use Martingale anymore, because your returns would be so incredibly small that you'd be better off just putting the market into a Standard & Poor's investment mutual fund type of thing, index fund, because you wouldn't be able to beat the market by the time you get to the 7th double. I hope that makes sense. There's a little bit of math that goes into it, but that's what I've discovered, and I've tried Martingale systems over and over and over again. The Martingale system that I use, and it's only with one strategy, totally separate account. It's nothing that I teach you guys as well. It's a personal venture that I have, right? The Martingale system that I have is it doesn't even double. It's more like it adds to the position, but it doesn't double it. Okay. The other thing that it does is it increases the target. So you're able to get more reward from the target rather than through the instead of manipulating the lot size, I solved that issue by manipulating the target. So you're increasing the target. Anyway, it's actually kind of intricate and complex, but I have this robot that's able to increase the reward more so through the target and not so much through the lot size, but the lot size is also manipulated as well, if that makes sense. So that's kind of what it is, and it's actually pretty awesome. But there's always that risk, and that's why I have other things in place to stop that if the trade were to go against you, a certain amount. There are circuit breakers in there to stop it before you would go to ruin. Okay, so that's what Martingale is. So you're just doubling. Pure Martingale in its simplest form is just doubling down a losing position. Okay, that's Martingale. And this is how you blow an account. This is how you, I think I told you guys this morning, the worst trade I ever took was a trade where I doubled down the pound dollar until it never got my favor. I got a margin call and my account closed, right? So is basically through Martingale type of trading. Okay. Now grid system's very similar type of toxic trading style. A grid system is a style where instead of doubling down a losing trade and closing out the previous trade and taking another position, grid is where you have specified trade levels. These could be figure levels. They could be just, very fixed levels in the market. So, every 10 pips, every 20 pips, 30 pips, whatever you select, and the market will then go and buy more whenever the market gets to another specific point in the grid. Okay, so you're adding to the position. You're still adding to a loser. Let's say you buy here and the market goes down 10 pips on the next component in the grid. You buy again, it goes below that, you buy some more, it goes below that, you buy some more. So it's similar to Martingale, but instead of closing out the trade, you're just adding to the position that you have all open. So that's a grid system. These also lead to ruin. I'd say this is perhaps the most common way to lose everything you have in Forex is through just simply buying and selling through a grid without any context behind the market. You're just buying and selling. That's all you're doing. And just adding to that position until it finally goes in your favor. Okay. There's a little bit more to it, and there's a lot of different types of grid systems, but that's what they are. Now, I do not recommend this. As you can tell, it will lead yourself into you'll get yourself into a big problem if you go down that route. So now let's talk about how we should trade and how you can actually develop and pass funding challenges, which, by the way, if you want to fail a funding challenge really quickly, use Martingale. If you want to fail a funding challenge and just blow a funded account quickly and lose your audition fee, use a grid system straight up. That's the fastest way to destroy a one of those types of accounts. Okay. It really is. Trust me. I've done it before. I've been through it. I've lost a lot of money doing that kind of thing. So what I've learned, and I've had to really kind of go through the ropes on this, is I've had to kind of submit myself and change and reprogram my brain to respect and use the stop loss, the trailing stop, and the lot size calculator. So these are the three things that I use to protect myself. This is how I tell everyone in our group to protect themselves in the market is through one of these three things. Well, not just one of them, but I usually recommend, first of all, stop loss is a must on every trade. 100%, you have to use a stop loss, and not just putting one in, but an appropriate one as well. There has to be some logic to the type of stop loss you're using. You can't just put one in and it's thousands of pips away. That's not helpful either. It has to be one that's based on logic, like I said. Then you also need to use a lot size calculator on every single trade. You don't need to use a trailing stop on every strategy, but there are some strategies where a trailing stop is a really, really good idea, right? So for those that don't know, a stop loss, what it does is it just knocks you out of a trade if it loses a certain amount of money. Now, you might ask, why would you want that? Well, you might want, let's say you buy a stock or a currency at $5 a share and your stop loss is at $4 a share, but that stock goes down to $2 a share. Well, you're glad you sold out and got out of that trade at $4 a share because it went down all the way to $2 a share, right? See, that's why we use a stop loss is to protect ourselves from significant loss. Although you will lose money with it, it's important to make sure that we lose the appropriate amount of money. Trailing stop is dynamic. What that does is it's a stop loss that moves with the market. If the market moves in your favor, trailing stop also moves up too. What this does is it preserves capital. And that's the first bullet of today, right? Is preservation of capital. So the trailing stop is there to protect you and protect the capital that you've already made, right? Position size calculator is hugely important. I didn't always use one of these for a long time. I actually was profitable without using one for a little bit, but my profits accelerated as soon as I started using a position size calculator. What this does is it helps you identify what lot size or contract is most appropriate for the type of trade you're taking, the currency pair you're trading on, the account balance you have, and the specified stop loss that you're using, right? What this does is it says, if you hit your stop loss, what percentage of your account are you willing to lose on that trade if you were to hit your stop loss? And that's where the lot size calculator comes in super handy. And this is why I say trading is the least risky thing I've ever done, because there is no lot size calculator on your 401k. There is no lot size calculator on your IRA, right? But there is trading if you use this. If you decide to use these things, then in my opinion, this is one of the least risky things you can trade. And not only that, but if you start to use this type of if you start to use these types of tools, this is what allows you to scale up and get millions and millions of dollars of funding. So I think I've shared this before, but my goal by next year, so end of next year, I have a plan. It's all laid out. You know, when I'm starting my funding challenges and with the amount of money I already have and the funded accounts I already have, just all that kind of stuff. I'm trying to get $10 million in funding by the end of next year. And the only way that that would be possible is if through these. If I didn't have these tools, I don't think I'd feel comfortable enough to go out there and try to acquire that type of funding. Okay. Yeah, this is the only way, in my opinion, to get there is through and it's boring sometimes, right? Just side note. So a lot of times people might say, well, why would somebody not want to use this? Well, it's because it's boring. Sometimes it hurts to hit your stop loss and be willing to say that you're wrong on a trade, right? But it's important to be willing to say I'm wrong. Okay. I think especially for me, sometimes as a guy, we don't want to be wrong. We want to make sure that everything we say is always right. But sometimes that it's a skill and it takes work to just say I was wrong, right? And the stop loss is basically action of saying I was wrong, and that's why I'm getting out. Okay. Stop loss will protect you in so many ways. Anyway, I have so many reasons why to say it's so important to use one, but let's continue. Okay, so let's talk about these risk management scenarios. And I want to go over this to help you guys understand what makes a profitable trader and what makes a losing trader. So scenario one is a one-to-one scenario. This is easy to understand. So let's say you take 100 trades and your win-loss ratio is 50%. And at a one-to-one risk to reward ratio, that means you would break even, because if you take 100 trades, you win half of them, you lose half of them, and you're at one-to-one, you should be breaking even. Now, breaking even isn't the goal. In fact, you'd actually lose a little bit of money because there's the spread and commission that you have to pay. So you actually lose a little bit of money at 50-50. You'd actually need to be a little bit better than that to break even. So that's not a great strategy, 1-to-1. It's also not the worst strategy either. I'm going to show you what a really bad strategy looks like in just a moment. But 1-to-1, I don't take these anymore. Okay. When I'm setting up my sniper trades throughout the week, I don't do 1-to-1s. Okay. 1-to-1s are everywhere. They're happening all the time on every single currency pair. But I don't want to take these because I don't think this is what's going to get you profitable. It's certainly not going to get me profitable. So I don't use 1-to-1s anymore. Okay. Scenario 2 is a 1-to-2 risk to reward ratio. In this scenario, it would be like having a 10 pip stop loss and a 20 pip target as an example. So if you took 100 trades and you won half of these trades, that would mean that you won 50 trades times a 20 pip target. That's going to equate to 1,000 pips. It also means that you lost half of those trades. So you lost 50 trades times 10 minus 10 as your stop loss. That means you would lose minus 500 pips. Okay. So if you made 1,000 on half of them and you lost 500 on the other half, that is a profitable strategy. That means you made 500 pips. Now, I actually don't like 1-to-2s anymore. I don't take 1-to-2s very often. I think if you'd asked me 6-7 years ago, I probably would have told you a 1-to-2 is great. To me, I think it's only good now. And I don't take them because the market can give you way better trades than this now. I've discovered that you can get way better than this. Okay. But it will work. And the other cool thing about this is you only need to win 33% of the time just to break even, which is actually pretty good because if you think about it, most traders lose money in this market. So if you're just breaking even and winning 33% of the time, you're actually not doing too bad. But ideally you want to win, half of your trades or more, and you want to be at 1-to-2 risk to reward ratio. So this can work. But in my opinion, this is much better. So here's scenario 3. This is a 1-to-3 risk to reward ratio. In this example, we'll say you have a 10 pip stop loss on average and a 30 pip target on average. So if you take 100 trades and you win half of those trades and you lose half of them, that means 50 trades times 30 pips as your target. That would equate to $1,500 or 1,500 pips in gains. If you lost, you would lose 10 pips per trade times 50 trades. That means you would lose 500 pips. So after the gains of 1,500 minus the losses of 500, you would net about 1,000 pips. Okay. That's pretty good. That's actually a good net gain and margin for the amount of loss that you've taken on. So to net 1,000 pips like that is great. What's cool about this is it only requires a 25% win rate to break even. Okay, so you could lose 75% of the time and you'd still be breaking even. Which is kind of cool. It's kind of nice to have that buffer. Obviously we don't want to break even, we want to make money. So anything above 25% on this you'd be profitable. So if you could figure out how to win about half of your trades, oh my gosh, yeah, if you're winning half of your trades at a 1-to-3, you're doing great. That's professional trade. That's a professional trader status level of trading at 1-to-3 and at 50%. So you could lose half your trades. You could even, I've had months where I lose 55% of my trades, 60% of my trades, and I'm only at 40% win rate, and I'm doing great. So I had that trade on the USD CAD over the weekend. It unfortunately lost, hit my stop loss, but I had several other trades last week that hit their targets with similar, actually, they were actually 1-to-4s, which is even better, almost 1-to-5s. And when you have those types of wins, then yeah, of course you can handle several losers because your win is so much bigger. then you're a loser, right? So yeah, you want to get to this. This is kind of, in my opinion, the golden ratio, 1 to 3, because they're also everywhere. These are very abundant in the market. You can find these every day on any time frame. I do think there's also a lot of 1 to 4s and 1 to 5s out there. So if you can try to aim for 1 to 4 and 1 to 5, you should. But I would, in my opinion, and this is just my style, my minimum is 1 to 3. Okay, so unless a trade offers me to 1 to 3, I'm not going to take it. Okay, that's my personal style. You can do what you want, but because I know that there's that many trades out there, why would you settle for less when you know you can get this type of a win? Now, the other thing I wanted to say about this is, as far as capital goes, we only have so much capital to deploy every single day, right? I don't want you guys going out there and taking, 20 different trades every day that might win a 1 to 4, 1 to 5, because if you lose several of those, you could lose 10, 20% in a day because you took 10 or 20% trades, and risking 1% per trade, you could lose a lot of money if none of those went in your favor, right? So to me, what I like to do is I like to find 3, maybe even just 2, but we'll say 3 to 4 trades a week is what I like to find. 3 to 4 really solid 1 to 3s to 1 to 5s a week, ones that I feel really confident about, and just take those. Right. There are other ways to get more trades like that, but the thing is, I've noticed if I try to overtrade and I skip and I try to take several trades in a day to make up if I have had a loser, I've noticed for me personally, I get things worse. So I'd rather come back the next day and try to find my next 1 to 3 or my 1 to 4. So every day I'm on the hunt for a 1 to 3 or a 1 to 4 once a day. But sometimes the market condition is just not right for what you're doing, right? So I'd rather let that market condition kind of play out. If it's going to cause me to lose, okay, fine. Take one loser, let that thing go away, and then look to take the next trade, right? That's my style, is look for 1, max 2 trades a day. But in reality, I'm just looking to take maybe 3 or 4 trades a week. That's it. And yeah, if you can win 2 of them at 1 to 3 to 1 to 4 or 1 to 5, and you lose 2, okay, you lose 2 at 1% a piece because you're using the lot size calculator. You're going through that process. You lose 2 of them. Okay, you lost 2%, but you had 2 others that made 3% a piece minimum. So you made 6%, but then you lost 2. Okay, now you end the week with +4, right? See, that kind of trading style is, in my opinion, the best way to go. At least it's worked for me, and I like that. And the other thing too, I just want to emphasize is it's really important. Again, don't try to overtrade in a day. If you happen to have a day that loses, let that trade lose. Let that market condition cycle out, come back the next day and try again with your trading style of looking for liquidity or however you're trying to do it, and get your 1 to 3 or 1 to 4, right? Okay. All right, last scenario. Now, this is not a good scenario. I'm going to say that early, but this is how, unfortunately, most people trade. Okay. Scenario 4 here is a 3 to 1 risk to reward ratio. What this means is you're risking 30 pips as an example, and you're only going for 10 pips. Another example could be risking 300 pips and going for 100 pips, right? This is not a good style. You will lose with this style. Trust me. Don't believe me? Open up a demo account. Please make sure it's demo. Do it in a demo account. Have fun trying, because it can be fun just to prove a point. But this will never work. Trust me, I've tried it so many times. It's very tempting. Some people might ask, well, why would anybody want to do this? It's because our brain wants to do this. Why does our brain want to do this? Because you want that quick win. Okay. You want to guarantee your win, right? You will have a high win-loss ratio with this type of risk management style. You will. You'll have several trades that you will have several trades that actually win this way. I was at a summit, a trading summit that I presented at back in 2016. I was in San Francisco presenting. And I remember as I was preparing to go on stage, I was listening to a conversation that a couple of traders were having. And this one trader, I'll never forget what he said. He said, if you just risk 100 pips per trade with a 2-pip take profit, he said this, you'll never lose because the stop loss is so far away. And I thought that is so ridiculous. I mean, I didn't call him out, right? I wasn't going to be rude or anything, but I just thought that's just so crazy. Like, can you imagine having a 100 pip stop loss and a 2-pip take profit? Yeah, you're going to win a lot of trades that way. You will win a lot. You're going to take little bites out of the market, little baby bites. You know, you're just going to, it's like cha-ching, 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 cha-ching. You're going to put little bites in your account, and that's really satisfying, right? To just hit lots of little wins like that. It's hugely satisfying. The problem is that the reckoning will come, right? So when you finally hit a trade where you go in with that 100 pip stop loss, eventually it will hit. And it won't take too long either, right? There will be a time where you hit that stop loss. And let's say you win, you win 90% of your trades with a 2-pip take profit. If you're gonna hit that 100 pips stop loss 10% of the time. So you lose 500. What would that be? You lose 1,000 pips, but in the same period of time, you made like 200. So you made 200, but you lost 1,000, right? But you have a 90% win rate. Does that make sense, right? So if you think about that, let's just actually do the math on that real quick. So yeah, if you win 90% of the time, but you're making 2 pips on average, that's 90 times 2. We can agree on that. So 90% of the trades, you're making 2 pips, you make 180 pips. Okay, makes sense. Then you have 10 trades that don't win out of 100 trades, and they all hit their minus 100 pip stop loss, right? Oh, so you'd be minus 100 pips times 10% of your trades. Yeah, it's 1,000 plus the 180 that you made. So you lose 820 pips total, right? That's a terrible trading strategy. Okay. And that's how a lot of people trade. You could go 10 days in a row and have no losses, or 9 days in a row and have no losses. And then on the 10th day, you hit just losses, and that will wipe out your account. How many of you have gone through that before? I have. I can't be guilty. I mean, I'm guilty of that, right? Like, and I'll be honest, I am guilty of that. So this isn't as bad as that scenario, but it's pretty bad. So a 1 to 3 has a 30 pip stop loss and a 10 pip target on average. And if you take 100 trades, if you win half of those trades, you will make about 500 pips, but then you'll lose 1,500 pips on the losing trades, right? So you'll lose 1,000 pips total. That's your net loss. This strategy also requires a 75% win rate just to break even, guys. So you're not even making money. You're just breaking even. And that also doesn't include spreads and commissions. So you probably are actually still losing money, even though you're winning 75% of the time. I see a lot of people who are pretty new to trading start talking about how they're winning 90% of their trades. I get really nervous when I don't know about you guys, but when I see somebody touting out a 90% win rate, I get very skeptical. I'm more excited about somebody who comes to me and presents a trading robot or a trading style or strategy, methodology, whatever it is that wins, 50% of the time. And but has a really good risk to reward ratio. Those I can get behind, and I can believe that somebody's actually doing that, because I know people, including myself and lots of others, who are doing that successfully and long term. I can get behind that, and I'm more likely to believe somebody for face value if they come to me telling me that, versus somebody who says I'm winning 90% of the trades. They might be winning 90% of their trades, but that doesn't mean that they're profitable, right? So some of the worst strategies I know have a 90% win rate. I know that sounds kind of weird, but that is the reality of trading. Best strategies are going to win 90% of the time, 80% of the time, which is kind of sad because sometimes I'll get on phone calls with people who are interested in joining the program, they'll often say, Steve, what's your win rate? And I'm like, that is the wrong question to ask. Like, I mean, I mean, it is a good question, but ask me first what my average win is to average loss. That's the right question. The first question you should ask me about my risk management style, and then ask me what my win loss is. Or if you're going to ask me win loss, make sure that you follow up with, okay, if that's the first question you ask, that's fine, but make sure you follow up with, now what is your average win to average loss? Because if you're winning, if somebody's winning 90% of the time and they have a 1-to-3 risk to reward ratio, that's amazing. Now, the thing is, I'd still be skeptical about that because I don't know anybody that's doing that. Versus I know tons of people who are winning 50% of the time and they're at 1-to-3, tons. That happens everywhere. Lots of traders are doing that. All right. Any questions up to this point? I just want to make sure that everyone's on the same page and that we're understanding this concept. This took me a long time to figure out because I was so when I first started trading, I was so attracted to the idea of just winning all the time. I wanted to go into the market every single day and I wanted to pull money out of the market every single day, which you can do, but I would see people that do that have really, really bad days and they just they don't tell you or you're not aware of it. So I used to work for a company, and I'm not going to name names here because I'm not like that, but I used to work for a company. This guy, he would pull out money practically every day in the market. And he actually did this. I watched him do it. You'd sit with him for an hour and he would just trade and take a lot of trades, and you'd watch him pull out $1,000 in an hour or $2,000 in an hour. You'd watch him do it. The thing is, though, I've been with that guy. I was with that guy long enough where I saw a couple of times where he would do the same thing, where he would, risk a lot of money to make a little. I watched that same guy in 15 minutes lose $15,000. Okay, so that's 15 days worth of work, because he would average $1,000 a day. Every day he would pretty much without fail make that $1,000, but then 15 days later, 20 days later, he'd hit a $15,000, $20,000 loss. And it's like, well, why does it matter that I made $1,000 every day if I'm going to lose 20,000 in the next, 20 days later, when the wrong market condition comes along and the wrong environment for the strategy comes along, and I'm just going to lose so much money, right? And I saw that as an issue. That's why I created the COT report strategy, because the COT report strategy does work well under a certain type of market condition, like any edge or any strategy does. Now, the thing that separates the COT report from a lot of other toxic strategies is that if it's wrong, we humble up and say, get out. The thing stops out for you. It's got a predetermined stop loss, predetermined lots. You're using the lot size calculator. You got the trailing stop to hopefully mitigate some of that if it's going to lose, right? So when we're wrong, we get out. Okay. When we're right, we stay in. And that's really how any strategy works. And the stop loss is just one of those examples of a strategy that works really well, because we do that. But I saw a lot of people in my first year's trading who blew a lot of accounts because they weren't willing to be wrong, and they didn't really have things in place to get them out when they were wrong, right? So your ego will destroy your trading. I'm just telling you right now, if you don't know how to tone or control your ego, you won't make it, okay? But you can change it, though. That's what's cool, is that if you have one right now, you can change it. I know that for a fact, that you can definitely change it. And it's also fun. I'm not saying I don't want to take the fun out of trading, because when you're right, pump your chest a little bit, right? Because that's fun too, right? Definitely get excited when you're making money. But don't let that get to your head either. Just make sure that when you're stopping out of a trade, be willing to say, yep, that didn't work. Okay, that's part of my losses. Book those away, move on, right? Okay, let's move on to the next. Oh yeah, I was just gonna say, don't trade this way. Exactly. Okay, so let's recap, and any questions you guys have, let me know in the chat box and I can go over those. Darwin says, hi, Steve, will there be a replay? I'm stuck at work. Yeah, for sure. So this will get uploaded to the calendar as soon as we're done here. It'll take about 20 minutes to process, but then it'll be up on the calendars. You can just go back and watch it afterwards. But yeah, I just want to recap some of the things that we talked about. So we talked about the why we need to have risk management. Preservation of capital is the number one reason, and you got to manage your emotions, and you need to have something that's sustainable long term. We talked about different toxic styles of trading, so Martingale, grid systems, these kinds of trading styles will get you into a big pickle, so please stay away from them. These are the things that you're going to use in my program to be profitable. You're going to have to use a stop loss. You're going to have to use a trailing stop. You're going to have to use a lot size calculator. Okay. By the way, if you need a lot size calculator, this is the one I like to use. I like to use this one from MyFX book, lot size calculator. This is the one that I like to use. TradingView's got several. You can look them up in the indicator section. There's also Cashback 4X. I'm going to give you that one, Cashback 4X. This is a good one right here. I'm going to put these all in the chat box. If you're on YouTube watching this, just send me a message. Either write me an email or just in the comment section, just ask for it and I'll comment it. By the way, if you're on YouTube watching this and you are interested in taking our trades, the Cot Report trades, and if you're interested in coming to these classes live, in the future, there's a link down below where you can start a 14-day free trial so you can come and watch these live. And there's a lot of other classes that I don't post on YouTube. So if you want to come to those, make sure that like the live trading classes, the Cot Report webinars, if you want to come to those, then you're going to need to start that 14-day free trial down below. Mark says, if you're trading a 10K account with a 1% risk and the account suffers a drawdown, do we continue to trade 1% of 10K or 1% of the current drawdown account size? That's a great question. Okay, so I think that kind of depends, Mark. And yeah, I've definitely thought about your question a lot. So it depends on how big the drawdown is. The way I do it is if I have a $10,000 account, I will continue to risk 1% of 10,000, even if that account goes down to say like 9,800, 9,500. I'll still keep managing it as if it's 1%. But if that account starts getting down to say $9,000, let's say you take a steep loss, you lose 10% of your account, which hopefully doesn't happen. But if it does happen and you get down to 9,000 from 10, I would start doing your next trades as 1% of 9,000. Okay. So I kind of do it as I approach the next figure level. So it's the same thing when I increase my account. So we had a lot of really good weeks. Not this week necessarily, we're just getting started. But if you guys remember, the last 2 or 3 weeks have been really good weeks for the Cot Report. We made a lot of money. So a lot of my accounts grew a lot. With my prop firm accounts, I keep it the same. So I had a couple of prop firm accounts that went from 200,000 to 210 or 220. I don't leverage those profits, unfortunately, on prop firm accounts just because that's not my way of doing it. If it's a prop firm account, I keep leveraging as if it's still the 200K account that it was. If it's a personal account and I have $100,000 in a personal account, and I get to my next checkpoint. So the way I do it, like if I in my personal account, when I have 100 grand and I get to 110, I will start going from 110. So I do it in $10,000 increments. So if I add another $10,000 to the trading account, I will start managing my risk as if it's 110 And then when I get to 120, I go to 120. But if that account's at 115, I don't usually do 1% of 115. I do 1% of 110 until I hit my next increment, right? So it works both ways. If you lose money, if you get to the next increment, then I guess you start doing 1% of that increment. But if you make money, you do 1% of that, and you can kind of decide what that is for you. I hope that helps, but that's a great question. Great. So I put those lot size calculators in there for you guys to use. We recapped everything. I think I answered all the questions. So, and guys, I just want to emphasize as we wrap up here how important it is to use a stop loss, because in fact, here's a challenge for you guys to do today. Maybe open up a demo account and start trading without a stop loss and just see how that goes in a demo account. Where you can't lose any of your own money. Try taking the COT report trades without a stop loss for a month. See how well you do without a stop loss. I think you'll still actually make money because the trades are pretty good. COT report generally does win, but I'm telling you that you'll probably end the month with way more money with the account that used the stop loss than the account that didn't use one, right? There have been weeks, in fact, if you actually just real quickly, if you go back and look at the COT report journal, there was a week where things were pretty bad. I had a really bad week back in October last year. Trying to find that week real quick. Let me find that really bad week. Yeah, here it is. So this was a terrible, terrible week. This was the worst week I've had in the last year. So October 25th, if you go look at this from 2022, everything was wrong. The whole thing was just wrong. Yeah, pretty much everything hit their flat out stop loss. And so this can happen. So just be aware that this is a possibility. That's why you have to use a lot size calculator. Had you not used a stop loss, if you go back and look at this week, go look at these 6 trades from that week. Technically, it's the following week because this is the Tuesday where the COT report came out. So it's the following week. So if you looked at the following week and had taken these trades, I think you would have lost closer to 2,000 pips instead of minus 800. Yeah, it's pretty bad, right? The week before that was pretty good. You made 1,500 the week before, but the very next week you would have lost 800 pips, but you would have lost closer to 2,000 had you not used a stop loss, right? So just wanted you guys to be aware of that. All right. Let's see. Mark says, thank you. Do you recommend any type prop firms such as Lux Trading? I believe 90% of firms. I'm not sure what you mean by B.book types. Let's see. Yeah, I'm not sure. Yeah, maybe. Yeah, I'm not sure if I quite understand the question. So the type of prop firms that I like Funded Trading Plus. I like Bespoke Trading. I like Funder Pro. The reason why I like these firms is because they offer unlimited time to pass your challenge, and most of them don't sacrifice your drawdown. So a lot of places will give you, like Surge Trader, for example, they'll give you unlimited time to pass your challenge, but there's a catch, right? The catch is you don't get as much drawdown to work with. So it's easier to fail your challenge if you have a bad week, right? With somebody like them. So I'm not a big fan of Surge Trader at all. In fact, ever since I discovered that, pretty much I haven't had a client sign up for Surge Trader since then, because it's not a great place to. I've had traders get funded with Surge Trader, and I've had traders lose their funded accounts at Surge Trader. And the whole goal is not only to get funded, it's to stay funded after you get that funded account. because that's how you're going to create your income going forward, right? And if you lose that account, then you have to start over again and try to get funded again, which happens. That's happened to me. And if you're going to try to get $10 million in funding, it's probably going to happen at some point. But you don't want that to happen at all or very often, because you want to make sure that you can keep that funded account for a long period of time before you run into the risk of losing it. So I don't like firms like Surge Trader because they're going to stop you out pretty quickly. If you have a bad week, they're not very forgiving, whereas a lot of these other firms are forgiving if you have a bad week. You know, they give you that 10% drawdown. You know, it's not a 6% or a 5% or whatever it is. So, and other places like My Forex Funds, they give you 12%, which is nice. 12% is pretty good. The only problem with them is it's relative. It's a relative drawdown, which Funded Trading Plus is also a relative drawdown, but I'm okay with it because they still give you the full 10%. And I should technically, if you're managing your risk correctly, you should never lose more than 10% of your account ever. So, oh, I didn't know that. So real prop firms versus demo prop firms. Yeah, I don't know. I don't know which ones. A lot of them don't offer demo accounts. The only one that I'm aware of is FTMO, that offers a demo account that you can open up. Yeah, that's the only one that I know of. Maybe Lux Trading Firm does. I don't know about them though. All right, guys. Well, appreciate your attendance today. Thanks for coming. Hope you have a fantastic rest of your day, and we'll see you guys in the next webinar.